Okay, so you want to own a McDonald's. You drive past one on your way to work, and the picture looks almost too easy. The cars keep coming. The drive-through never seems to stop. Families buy meals. Teenagers buy fries. Someone orders a burger at midnight. And because the food itself is relatively inexpensive, compared with the price on the menu, the obvious conclusion is almost impossible to avoid. This must be a fantastic restaurant business. You buy a building, you hire some employees. You sell burgers, fries, and drinks. Customers pay you. You keep the difference. Simple. Except that is not really how the McDonald's economic machine works. Because if you think McDonald's is primarily a company that makes money by selling hamburgers, you are looking at the least interesting part of the business. In 2025, McDonald's generated more than $139 billion in system-wide sales across its restaurants worldwide. But the corporation itself reported only $26.9 billion of revenue. That enormous gap exists because most McDonald's restaurants are operated by franchisees. The franchisees collect the customer sales, while McDonald's collects contractual payments from those restaurants. And that difference changes everything. McDonald's is not simply a burger company. It is a franchise, real estate, royalty, and operating system business that happens to sell burgers. That is the reframe. And once you understand it, the golden arches start looking less like a restaurant chain and more like a financial machine built around thousands of local businesses. So let's start where every aspiring owner has to start, with the money you have to spend before the first customer ever orders a Big Mac. Because the first surprise is that getting into the business is not as simple as paying a franchise fee and opening the doors. In the United States, McDonald's currently says prospective franchisees typically need at least $750,000 in non-borrowed, unencumbered personal funds just to qualify financially for consideration. The company also recommends at least $100,000 in working capital per restaurant and another $75,000 for relocation expenses. And that $750,000 is not the price of a new restaurant. McDonald's explicitly says a brand new restaurant requires a greater investment. Then there is the actual restaurant, a recent McDonald's US franchise disclosure analysis based on the 2025 FDD puts the estimated initial investment for a traditional restaurant at roughly $1.47 million to $2.73 million, depending heavily on the location and circumstances. The initial franchise fee itself is $45,000. But that fee is almost the least interesting number in the entire calculation. Think about what is sitting behind that investment. The building, the kitchen, the equipment, the drive-through, the signs, the seating, the technology, the site improvements, the opening inventory, training, professional fees, and enough cash to survive the period before the restaurant reaches its normal operating rhythm. So if you walk into this thinking, "I'll just buy the franchise," you've already missed the first economic reality. You're not buying a logo. You're buying into an operating system that can require millions of dollars of capital. And there is another unusual feature. McDonald's does not simply let you choose any piece of land and put the golden arches on it. In the United States, the company says site selection is separate from franchisee selection. McDonald's evaluates locations, and when it decides to develop a site, it can acquire the property and construct the building before awarding the franchise to a qualified candidate. That matters because location is not just where the restaurant happens to be. Location is part of the product. A restaurant beside a major highway, a busy intersection, a shopping center, or a dense residential area has a completely different economic potential from one hidden behind a quiet road. The building may look identical. The menu may be identical. The kitchen equipment may be identical, but the economics can be completely different. And that brings us to the first major question. Where does the money actually come from? McDonald's has several revenue engines, but four matter most when you understand the machine from the corporation's side. The first is rent. The second is royalties. The third is initial franchise and related fees. And the fourth is sales from restaurants McDonald's operates itself, plus other revenue. The interesting part is that these streams don't carry the same economic weight. Let's start with the one most customers never think about: rent. When you walk into a McDonald's, you are thinking about food. The corporation is thinking about the restaurant's economics. In many franchise arrangements, the agreement combines the right to operate the restaurant with a lease or occupancy arrangement. McDonald's generally maintains control of the underlying real estate and building during the franchise arrangement. At the end of a typical 20-year arrangement, McDonald's can renew with the existing operator, choose another operator, or close the restaurant. That creates something extremely powerful. The franchisee is running the restaurant, but McDonald's can retain control over the location. So when the franchisee sells burgers, the transaction can create several economic consequences simultaneously. The customer pays for food. The franchisee pays employees. The franchisee buys supplies. The franchisee handles day-to-day operations. And McDonald's receives rent and other contractual payments. That is the first major reversal. You might think McDonald's wants the highest possible burger price, but the deeper objective is to create restaurants that generate strong sales for decades, because strong sales support the entire franchise economics. And the rent itself can be significant. McDonald's says rent can involve fixed amounts, percentage rent, or a combination depending on the arrangement. Its 2025 UK franchise data, for example, shows that the monthly rent payable by 80% of restaurants franchised during 2025 ranged from 8% to 18% of net sales. The U.S. economics vary by restaurant and lease structure, so there is no single universal rent percentage that applies everywhere, which leads to the second engine, royalties. Every time a customer buys a meal at a franchise McDonald's, the franchisee does not simply keep the entire sale after paying operating costs. A portion goes back to McDonald's under the franchise agreement. The precise rate depends on the agreement and timing. Recent U.S. franchise disclosure data indicates a 5% royalty rate for new restaurants, while older agreements can have different rates. And this is where the model becomes beautiful from the franchisor's perspective. Imagine two businesses. Business A sells $4 million worth of burgers. To make those sales happen, it has to employ hundreds of people over the course of the year, buy food, pay utilities, maintain equipment, deal with waste, manage schedules, and absorb the consequences when customer traffic falls. Business B doesn't necessarily need to operate the restaurant at all. Instead, it creates the brand, system, real estate structure, training, technology, and standards that allow someone else to operate the restaurant. Business B then collects a percentage of sales and occupancy-related revenue. That is a fundamentally different risk profile. And McDonald's financial statements show exactly how powerful that difference has become. In 2025, McDonald's reported $16.548 billion in revenue from franchise restaurants. That figure consisted of approximately $10.442 billion in rents, $6.018 billion in royalties, and $88 million in initial fees. Notice what just happened. The largest components of McDonald's franchise revenue are not hamburgers. They are rent and royalties. That is the real engine. Then there is the third stream, initial fees and franchise-related payments. When a new franchise relationship is created or an existing restaurant changes hands under the system, McDonald's can collect initial fees. But this isn't where the empire is built. In 2025, initial fees were only $88 million, compared with more than $16.5 billion in total franchise restaurant revenue. And that tells you something important. The franchise fee gets the owner into the system. The recurring economics are what make the system valuable. The fourth stream is company-operated restaurant sales. McDonald's still operates some restaurants itself. In 2025, those company-operated restaurants generated $9.69 billion in sales. Add another $647 million of other revenue, and the corporation reached total revenue of $26.885 billion. But here's the counterintuitive part. The company-operated restaurants generate the full customer sale as revenue. That sounds better. It isn't necessarily better for profitability, because when McDonald's operates the restaurant itself, McDonald's also carries the restaurant operating costs: food, labor, utilities, maintenance, insurance, equipment, everything. And the numbers make the difference obvious. In 2025, McDonald's recorded $9.69 billion in sales from company-operated restaurants and $8.268 billion in company-operated restaurant expenses. That left approximately $1.422 billion of company-operated restaurant margin before the other corporate costs. Now compare that with franchise restaurants. McDonald's generated $16.548 billion in franchise restaurant revenue while reporting $2.618 billion in franchise restaurant occupancy expenses. That leaves approximately $13.93 billion of franchise restaurant margin before the remaining corporate expenses. That is the twist. The part of McDonald's that looks smaller on the income statement produces the much larger economic contribution. The company is not trying to personally flip every burger. It has built a system where thousands of independent operators do most of the operational work while McDonald's monetizes the system around them. And there is an even bigger number. At the end of 2025, McDonald's had 45,000 to 356 restaurants worldwide, and approximately 95% were franchised. So the restaurant you see is only one layer. Underneath it is a network of contracts, real estate, brand licensing, supply relationships, technology, training, marketing, operating standards, and recurring payments. But this is where people make another mistake. They look at McDonald's corporate margins and assume a franchisee must be making an enormous amount of money. Not necessarily, because the economics of the corporation and the economics of the individual restaurant owner are completely different. And this is where the hidden bleed begins. What nobody tells a first-time owner is that a $4 million restaurant is not a $4 million business in the sense most people imagine. The $4 million is sales. It is not profit. In fact, McDonald's 2025 franchise disclosure data showed that traditional U.S. franchise restaurants that had been open at least a year averaged roughly $3.97 million in annual sales during 2024, with a median around $3.8 million. Those figures describe sales volume, not what the owner takes home. Now start taking the money apart. Food costs, paper products, labor, payroll taxes, insurance, utilities, repairs, maintenance, small equipment, accounting, legal expenses, local taxes, advertising, franchise payments, rent, debt service, and potentially the owner's own management compensation. The franchise disclosure pro forma is revealing here. For restaurants in the $3 million to $3.4 million annual sales range, the disclosed cost of sales was roughly 28% of sales, while other operating expenses ran around 45% to 47% before rent, service fees, depreciation, interest, and income taxes were accounted for. That produced operating income before occupancy costs in the neighborhood of 24.5% to 25.9%. That sounds incredible. Until you remember the words before occupancy costs. Rent is still waiting. And rent can be one of the most dangerous variables in the entire model. Because food costs generally move with sales. If you sell less food, you buy less food. But rent does not necessarily care how many customers show up. Your lease still exists. Your building still exists. Your equipment still exists. Your insurance still exists. Your management structure still exists. The restaurant can look busy and still be economically mediocre. It can look quiet for 2 hours and still be profitable. That is why sales volume alone tells you almost nothing about the owner's final return. Then there is labor. A McDonald's restaurant is a choreography problem. You need people on the front counter, people in the kitchen, people handling drive-through orders, people preparing food, people cleaning, people managing inventory, people supervising shifts. And you need enough people during peak periods without carrying unnecessary labor during slow periods. That sounds simple until you realize that demand doesn't arrive evenly. A restaurant might be relatively quiet at 9:30 in the morning. Then lunch arrives. Then school lets out. Then dinner arrives. Then late-night traffic begins. The owner is constantly balancing speed against labor. Too few employees, and the line gets slower. Slower service creates customer frustration. Frustration reduces repeat visits. Too many employees and labor costs consume the margin. This is why a restaurant can lose money without ever looking like it is failing. There is also waste. Food expires. Orders are made incorrectly. Ingredients get damaged. Equipment breaks. Customers demand refunds. Employees make mistakes. Delivery orders create additional complexity. A fryer goes down. A refrigeration unit fails. A drive-through system needs repair. None of these events necessarily make headlines, but thousands of small leaks can destroy a year's worth of expected profit. And then there is financing. This one is almost invisible from the parking lot. A franchisee may have a restaurant producing millions in annual sales while simultaneously making substantial debt payments on the acquisition. The restaurant can be operationally profitable while the owner's actual cash return remains much smaller after financing costs. So when someone says that McDonald's makes $4 million a year, the correct response is $4 million in what? Sales, gross profit, operating profit, cash flow, owner income? Those are completely different numbers. And this is where the story becomes more interesting. Because despite all those costs, some operators don't just survive, they build enormous businesses. Consider the Dias family. Paul Dias started at McDonald's as restaurant crew at age 16 in the Sacramento area. He worked his way into management. Then an opportunity appeared to acquire his first restaurant in Colorado. He and his wife moved with their daughters. The first restaurant performed well enough that he eventually sold it and pursued another opportunity in Arizona. The operation expanded. 5 restaurants became part of the Tucson story. And today, McDonald's says Paul Dias owns 23 restaurants in southern Arizona. That is not the story of someone who simply bought a burger shop and waited for customers to arrive. It is the story of someone who learned the operating system, understood the economics, built sales, managed people, and then scaled. And that distinction is critical. Because the franchise model rewards operational competence, the brand can bring people through the door. But the operator still has to turn those customers into profitable transactions. The Dias story also reveals something else. The real opportunity isn't necessarily owning one restaurant. It can be building a portfolio. One location teaches you the system. The second gives you scale. Then management becomes more important than personally standing behind the counter. You start thinking about recruiting managers, training, capital allocation, site economics, maintenance, restaurant performance, and the return on each additional location. That is how a restaurant franchise turns into a business empire. But now let's take the same model and stress test it, because this is where the glamorous version of the story starts to break apart. Imagine a traditional McDonald's restaurant generating about $4.1 million in annual sales. That figure is close to the current U.S. average sales range disclosed for traditional restaurants, although individual locations vary enormously. We'll call this the optimistic case. Not because $4.1 million is imaginary, because the outcome depends on the restaurant actually converting those sales into strong operating performance. Start with $4.1 million. Suppose food and paper consume roughly 28.5%. That's about $1.17 million. Now you're left with roughly $2.93 million. Then assume the other operating expenses run around 45% of sales. That's approximately $1.85 million. Now the restaurant has roughly $1.08 million remaining before occupancy and certain other costs. This is broadly consistent with the scale of the operating income before occupancy economics disclosed in McDonald's franchise data. Now the hidden bills arrive: royalty, advertising-related costs, rent, depreciation, interest, taxes, owner level, overhead. And suddenly the headline $4.1 million restaurant is no longer a billion-dollar-looking machine. It is a capital-intensive operating business whose final return depends heavily on the lease, financing structure, and discipline of the operator. Now let's build a second scenario. Same golden arches, same menu, same city, same restaurant. But this time, sales fall by 10%. Instead of $4.1 million, the restaurant produces roughly $3.7 million. That sounds survivable, and it is. But the economics do not fall evenly. Food costs decline because fewer meals are being sold. But many expenses don't fall nearly as quickly. The building still has to be occupied. Equipment still needs maintenance. The manager still needs to be paid. Insurance still exists. Technology contracts still exist. Debt still has to be serviced. And the franchise-related payments continue. So the restaurant doesn't necessarily lose 10% of its profit when sales fall 10%. The impact on profit can be much larger. That is operating leverage. And restaurants are full of it. This is why the busiest-looking location isn't automatically the best investment. The best location is the one where sales are strong enough to spread the fixed costs over a huge number of transactions while keeping labor, food, occupancy, and financing under control. Now make the situation slightly worse. Suppose food costs rise. Suppose wages increase. Suppose the local labor market becomes more competitive. Suppose rent is high. Suppose a major road construction project temporarily reduces traffic. And suppose a competitor opens 2 miles away with aggressive discounts. None of these events needs to destroy the restaurant, but together they can turn a spectacular return into an average one. And that is the real difference between the optimistic and realistic scenarios. In the optimistic version, the restaurant is a machine. High traffic, strong average ticket, efficient labor, controlled waste, reasonable occupancy, stable financing, strong management. In the realistic version, the restaurant still looks busy. Cars still line up. People still buy fries. The golden arches are still glowing. But the owner's cash flow has become dramatically thinner. That is the hidden danger. Customers see sales. Owners see expenses. McDonald's corporate sees something different again. It sees recurring rent and royalties flowing from a global network. And the numbers at the corporate level demonstrate why that model is so powerful. In 2025, McDonald's reported $26.885 billion of total revenue and $8.563 billion of net income. That means the company converted roughly a third of reported revenue into net income. But remember what is inside that revenue. More than $16.5 billion came from franchised restaurants. And that franchised revenue was overwhelmingly made up of rent and royalties. So, the corporation does not need to make its money the same way the franchisee does. The franchisee needs the restaurant to perform. McDonald's needs the entire system to perform. That is a huge distinction. If one restaurant has a bad month, McDonald's has thousands of other locations. If one franchisee struggles, the brand can still collect revenue from the wider network. If one location closes temporarily, another location may continue producing. The system diversifies the individual restaurant risk. And scale creates another advantage. Marketing, technology, menu development, training, purchasing power, digital ordering, loyalty programs. McDonald's can spread these investments across tens of thousands of restaurants. A local independent burger restaurant cannot. That's why competing with McDonald's isn't simply a matter of making a better burger. You are competing against decades of infrastructure. And that infrastructure has a compounding effect. More restaurants create more brand familiarity. More familiarity creates more customer trust. More customers create more franchise sales. More franchisees create more locations. More locations create greater purchasing and operating scale. And greater scale makes the system harder to attack. That's the flywheel. But there's an even deeper part of the story. McDonald's does not just sell franchise rights. It sells predictability. If you walk into a McDonald's in one city and another McDonald's hundreds of miles away, the experience is designed to feel familiar. The menu is familiar. The packaging is familiar. The ordering process is familiar. The operating procedures are familiar. The franchisee gets a system. The customer gets consistency. And McDonald's gets control. That control is economically valuable. Because a franchise system without standards eventually becomes a collection of unrelated restaurants, McDonald's has spent decades making sure that does not happen. The company says nearly 95% of its restaurants worldwide are owned and operated by local franchisees or developmental licensees. That means McDonald's can expand its physical footprint without personally funding every restaurant's daily operation. And that is the real genius. The franchisee brings capital. The franchisee brings labor. The franchisee manages the restaurant. The customer brings the money. McDonald's provides the brand, system, standards, technology, marketing infrastructure, and, in many cases, the real estate relationship. Then, everyone gets paid according to their role. So what would happen if you actually wanted to own one? The first thing to understand is that this isn't a passive investment. McDonald's says U.S. candidates entering the training process must be prepared to commit to daily restaurant management and complete an extensive 6 to 12-month training program. Candidates also need to be prepared to relocate depending on where restaurant opportunities become available. You also cannot simply show up with money and demand the best location. The company evaluates candidates. It evaluates restaurants. And it controls the system. That's why the franchise has value. But that's also why the franchisee gives up freedom. You don't get to redesign the menu whenever you want. You don't get to ignore operating standards. You don't get to decide that cleaning the equipment isn't important. You don't get to turn the restaurant into your own personal burger concept. You are buying into a machine that existed before you, and your job is to operate your part of that machine better than the previous owner. That is why the business can be so difficult to understand from the outside. The customer sees a burger. The employee sees a job. The franchisee sees a restaurant. McDonald's corporate sees a network of contracts and assets producing recurring cash flows. And investors see something even bigger, a global franchise platform. In 2025, the company reported more than $139 billion in system-wide sales, up 7% from the previous year. Loyalty member system-wide sales alone approached $37 billion, while active loyalty users reached nearly 210 million at year-end. That tells you where the business is heading. The future McDonald's is not simply a place where people buy burgers. It is a physical retail network connected to digital ordering, loyalty, delivery, real estate, and franchise economics. The burger gets the customer into the system. The system creates the recurring economics. And that brings us back to the original question. How much money can one McDonald's make? There is no single answer. The company itself warns that franchise profitability depends on operating costs, occupancy costs, financing terms, and how effectively the restaurant is managed. But the available numbers give us the shape of the equation. A traditional U.S. franchise restaurant can generate roughly $4 million in annual sales. Food and other operating expenses can consume the majority of that revenue. Occupancy can vary dramatically. Royalties and advertising payments come out of the economics. Financing can materially change the owner's cash return. And the final profit can differ enormously from one location to another. The important equation isn't sales minus food equals profit. It's sales minus food, labor, operating expenses, rent, franchise costs, financing, and maintenance equals the owner's actual economic return. And then there is a second equation that matters even more to McDonald's itself. Franchise network plus real estate, plus royalties, plus recurring rent equals a business that can scale without McDonald's operating every restaurant. That's why the franchise model is so powerful. Now consider the two scenarios one last time. In the optimistic scenario, you have a high-volume restaurant doing roughly $4 million or more in annual sales. Costs are controlled. Labor is efficient. Waste is low. The lease is manageable. The restaurant is well-positioned. The operator is excellent. The location generates enough transactions to spread fixed costs. The investment can produce an attractive return. Now take the realistic scenario. Sales fall by 10%. Food costs rise. Labor becomes more expensive. Rent remains fixed. Maintenance increases. Debt payments don't disappear. Suddenly, a restaurant that still looks successful from the parking lot can produce far less cash for its owner. And that's why the real McDonald's business is not about selling the most burgers. It's about controlling the economics surrounding every burger. The company doesn't need to personally own every restaurant. It needs the restaurants to remain valuable enough that operators want to pay for the right to run them. It doesn't need to collect every dollar customers spend. It needs to own the most valuable layer between the customer and the franchisee: the brand, the system, the contract, and, critically, the real estate. That's the part most people miss. When you look at a McDonald's, you see a restaurant. When McDonald's looks at that same building, it can see an operating agreement, a long-term location, a franchise relationship, a stream of rent, a stream of royalties, and a customer base that already understands the brand. That is an entirely different asset. And it explains why McDonald's can generate enormous corporate profits, even though it does not record every burger sold at every franchise restaurant as its own revenue. The customer spends the money at the restaurant. The franchisee runs the restaurant. But McDonald's has designed the system so that money can flow upward through several different channels: rent, royalties, fees, and, where applicable, company-operated sales. That is the machine. And the machine becomes more powerful as it gets bigger. More locations, more customers, more franchisees, more data, more brand recognition, more purchasing scale, more digital users, more real estate relationships, more recurring revenue. The burger is the visible product. The franchise system is the invisible product, and the real estate underneath it makes the whole structure even harder to replicate. So the biggest lesson from McDonald's is not how to sell a Big Mac. It is how to build a business where other people can operate the physical storefront while you continue to participate in the economics of the system. McDonald's didn't become one of the world's most valuable restaurant businesses simply because it found a way to sell hamburgers faster. It built a machine where the restaurant, the franchisee, the customer, the brand, and the property can all create value at the same time. McDonald's is not primarily in the burger business. It is in the business of turning real estate, franchising, and consumer demand into recurring cash flow. And once you understand that, the golden arches look very different. Because the next time you drive past a packed McDonald's, don't just look at the cars in the drive-thru. Look at the building. Look at the land. Look at the franchise agreement. Look at the recurring payments. And then ask yourself one much bigger question. What other famous companies are secretly making their money from something completely different from what customers think they're buying? Because once you start looking at businesses that way, the most profitable part of the company is often hiding in plain sight. If you enjoyed breaking down the business behind the brand, drop a comment and tell me which company you want us to dissect next. And subscribe if you want more videos that go beyond the product and show you where the money actually flows.